How do you get paid when you sell a company? What's the timing of it? What needs to happen? What's at closing? What's after closing? How does this all work? That's what we want to dig into in today's video. So we're going to use our whiteboard as we have in a few prior videos to walk through how closing consideration works and to walk through the 3 different ways you can get money after the closing and how it all works. I'm Arthur Petropoulos, managing partner and president here at Hillview Partners. We're a middle market, lower middle market investment banking firm, helping companies generating $1 million to $20 million a year in pre-tax earnings or profit to sell their companies and to secure capital. So in that effort, we're always looking at, as we said, in a deal or in a sale of a company in particular, we're looking at value, structure, transition, stakeholder considerations. And today, we're going to dig a little bit more into structure, and that is how much of the deal value are you getting at closing, how much is over time, and how does it all work? And so going to the whiteboard, let's draw a vertical line up and down. To the left, we're going to have the stuff that happens at closing, and to the right, we're going to have the stuff that happens after closing. So here, it's just write closing, closing. And what's here, let's say after. So simple enough, the stuff that happens at closing is you get that, as the word implies, at closing. So if there's cash, you're going to get cash. If there's equity in something, or let's draw a stock certificate, you're going to get that. If there's anything else that you were supposed to be paid with, you would get it then. But it's going to be one of those 2 things. You're going to get cash or you're going to get some stock in the company that's buying you. Predominantly, it's going to be cash at closing. And that's usually the biggest part of a transaction. So if you're selling a company, we've seen situations where 50% of the company or 50% of the proceeds are cash at closing. We've seen it up to 100%. A lot of times you're going to see, depending on how the deal is structured, and if you have a good investment banking firm representing you, oftentimes you will see 70 to 90% tend to be kind of the tighter part of the bullseye, let's call it. But in either case, you're going to get some portion of the deal at closing tends to be cash, could be some equity if it's negotiated that way. Now let's look at after closing. And this is where you're going to have really 3 main ways of getting post-transaction consideration, the stuff that you get after you sell the business. And so the first of these is going to be a seller note. And so you can think of a seller note as a loan. So when people say, will the seller provide financing? Will the seller hold paper? Will there be some sort of a seller note that could be amenable? And what that is someone will just say, effectively, let's take an 80-20 situation. 80% of the considerations at closing in cash, 20% is a seller note. Seller note typically takes the form of an 8% loan effectively over 3 years. And so you're not actually taking money out of your pocket and lending it to the buyer, but you're basically just taking some portion of the purchase price that they're supposed to pay you over time. And so again, we sometimes see this be a 2-year thing. We've seen people offer 10, 12 years. We really don't want it to get beyond 5 years. And this is going to be fixed payments. Typically, it's going to be principal and interest. So what they would say is a fully amortizing note. There are certain situations where we've had interest only for a period of time. We've had, you'll hear a lot of search funds talk about standby where there's no payments for the first year, but the interest accrues, or a PIK or a payment in kind. But for the most part, the simplest way you can think of this is 80% of a deal gets paid at closing, 20% gets paid over 5 years in 60 monthly increments, and all looking like a amortization schedule like a home mortgage. But nothing has to happen besides the passing of time with the seller note. It's just a fixed debt that must get paid back over time. So it's simple, but does take some time. Now, second is an earnout, and this is where things can get a little bit tricky. And so in an earnout situation, it basically means certain things have to happen for you, the seller, to get paid this piece of the consideration. Oftentimes the earnout can be kind of the highest bucket, or a kicker or an enhancer to the value. So in some situations, you'll see 80% of the value is paid at closing, 10% is a seller note, 10% is an earnout. And so sometimes the buyers will try to position it that we're going to give you 100% between the consideration at closing and the seller note, and then the earnout's actually going to let you earn even more if certain things happen. It's a bit of semantics. From our perspective, we say, what is the total value of all the stuff you are offering? And if an earnout is included, we consider it part of the consideration. So, earnouts can be good, earnouts can be not as good. It's all a product of what it is that you are agreeing. If someone says, you'll get a $1 billion if you can jump over a Twinkie, well, that's fine. If someone says you can get $1 million if you can jump over the Statue of Liberty, not so fine. So as it pertains to business, in an earnout, which you'll see sometimes, is that revenue has to hit a certain target. Revenue has to, sometimes you'll see an EBITDA earnout. Those are a little bit trickier because the buyers can have a lot of influence. You have to very, very clearly define how EBITDA will work after the transaction so you don't get certain expenses stuffed into your operating uh, costs. And it has to do with whether or not you as a seller are going to stay involved. If you're going to stay involved and still be running this business unit or have a lot of influence on it, well, then perhaps you'd be more amenable or open to taking some of the consideration predicated on certain targets being hit. If you're not going to be part of it, then you're probably not going to want to have earnouts because you're not going to be there to influence it. And if the buyer messes things up in some way, you don't really want to be responsible for it if you can't control it. Remember, you always want to remember anything you are responsible for, you need to have an element of control. Therefore, earnouts are most appropriate when you are going to stay for some transition period and have a heavy impact on the ability to hit these earnouts. Now, again, these earnouts can be revenue-based, can be profit-based. We'd prefer it to be revenue-based. If it is revenue-based, a lot of times the buyer will say you have to hit these targets above the existing revenue. We would prefer it to be, do you hit the existing revenue in the sense of, are you just keeping revenue flat? And what happens is someone will say, okay, if you hit certain targets of revenue over the next few years, you will get X dollars. And then what we say is we don't want it to be a binary outcome. What we mean by binary outcome is we don't want it to be a situation where basically you either get all of it or you get none of it. And so what happens then is there's this dialogue. So they say, okay, we want you to hit revenue that's 120% of your existing revenue. We say we'd like it to just be flat and hit the existing revenue. And they'll say, well, how about we land at 110%? And we say, okay, but we don't want it to be binary. We don't want it to be a do or die where you can only get it 100% or 0%. So they say, okay, we'll build in a ratchet. So effectively, if you hit 70% of the target, you'll get some percentage of the earnout. And then we say, well, if we have a downside to the earnout, we want an upside to the earnout. And so if we hit it by 150%, we want something extra. And so that's the way we tend to look at it. And so I guess the visualization will be kind of like a meter almost of, where do you get it? And so earnouts, the key elements to earnouts, you want it to be definable clearly. You want it to be achievable, but you also don't want it to be a binary or a do or die. And that's really the devil's in the details in terms of negotiating these. Now, item number 3 of post-transaction consideration is an equity rollover. Sometimes people call it an equity carry forward, an equity roll forward, but think of it as a rollover. And that's basically just taking some portion of your company that you own, and now you're going to own stock in what somebody else owns. And so you can think of it as the stock consideration that you get at closing is really a rollover because basically it is an ownership in something else. And so say you sell your company to a private equity firm, a lot of times they'll come in and they'll pay 80% cash for your company and 20% rollover, which means 20% of the value. So if you have a company that makes $4 million in EBITDA and someone's paying $28 million for it, so say it's a 7 times multiple, and they say, okay, a quarter of that, so 7 million out of the 28 million is going to be equity rollover. Well, then basically you're getting 75% in that situation. So it's not 80%, but say 75% cash at closing, 25% of the deal is going to roll forward into ownership into a larger entity. Now, if private equity already has a platform with other stuff in it, then you're going to own like a malformed chocolate chip cookie. But in this situation, if there's other portfolio companies that already exist within this thesis, well, your 25% or so may equal 10% of this larger aggregation, but it's obviously going to be generating more cash flow as it stands. So effectively, your economic value should be the same. And so what happens is people say, the buyer says, I want to buy the company, and 75% is going to be cash at closing, 25% is going to be an equity rollover. The question that you should be asking is, what am I going to own? And they're going to say, well, you're going to own a piece of this larger thing that I usually has other companies already part of it. And you have to say, well, if my company has X amount of EBITDA and I have 25% of that, now I'm trading it for 10% or 9% or 8% of this larger thing. How much EBITDA is that generating? And basically, am I getting, it's okay if you're getting a different shape of a pie, but you want the same slice. You want it to have the same economic value. And so that's where it's important to say, I want to see the financial statements of what I'm going to be a part of. I want to understand what percentage of it I'm going to own. I want to make sure that if I'm giving $7 million out of $28 million, I want to make sure that I feel comfortable that what I own is at least worth $7 million today. Now, the goal of a rollover in an equity, private equity type of situation in particular, is that they are going to keep buying other companies and they're ultimately going to exit. So a lot of times we call this the second bite at the apple. So private equity comes in, they buy your company. Typically, they'll own a thesis, if you will, for 5 to 7 years. So say private equity is already 2 years into a thesis of consolidating companies in the chocolate chip cookie space. Now they come and they buy your cookie company and they say, hey guys, we're going to give you 75% of closing, 25% as a roll forward into our company. And basically, we're expecting to hold it for another 3 years and keep growing it. So the goal would be that this rollover, for every dollar you put in, it should turn into, I like to say, 3 times that amount of money. We've had situations where it's been 6 times. We've had situations where it's been as low as 1.5 times if it hasn't performed. Now, people will always say, like, I don't want to have this rollover stuff. It's wampum. It's, I don't know what it is. And so the assurance that it's going to be valuable is we always make sure that you're going to own the same exact thing that the buyers own. So if the private equity firm says we have shares that we're going to give you, I say, self-interest is the greatest insurance policy on earth. Do you own the same shares? Are we going to own the same stuff as you? And if the answer is yes, you can rest assured it's not going to be worthless. And in many cases, it's going to be worth considerably more. You don't want some sort of B share, some preferred equity. You want to eat the same cooking that everybody else is eating. And then secondly, you want to know the timeline. If it feels like it's going to be a longer duration, we're going to own this thing for 5 years, 6 years, 7 years, 10 years. A lot of times what we'll negotiate in for the seller is a liquidation preference. So we'll basically say, look, at the end of 3 years, if we don't like the direction of things, we want to be able to liquidate our equity ownership with an 8%, let's call it, appreciated value. So basically, the long-term return in the S&P is 7%. So we always say, if we beat the S&P and we have the ability to monetize that equity stake at that juncture, then at least that's kind of the worst case scenario, is that after 3 years of compounding, we're going to be at, call it, 1 and 1.4 or 1.3, worst case. Now, what I will say is I've not had any sellers. There's been some that are contemplating it partially for monetization, but we haven't had any sellers that actually do want to liquidate once they get to that point. Because once they see the stock price, there's an internal value attributed to the equity rollover. Once they see that start to increase and say, wow, it's only been 3 years and we've already doubled, they tend to want to stay in for the whole ride because it turns out, well, private equity, they're not dumb people. And that's why, obviously, you have to negotiate very strong for your interest. But once you have a piece of what they are building, it tends to perform very well because they are disciplined buyers and they are strong operators. Summary of today's video: when you get paid for the company you sell, it's going to be in 2 chunks. You're going to have what you get at closing and what you get after closing. I hope the week's going well for everyone. Keep pushing forward. God bless. We'll see everyone next time.